Okay, another exciting week in mortgage land. This week, we have the PCE coming out on Friday. That's the Personal Consumption Expenditure Index. It's one of the three major inflation reports that the Federal Reserve watches closely to see. Expectations are that we'll see the headline number drop from 3.8% down to 3%. Might even see a two handle. It's possible it could be at 2.9. We'll see. If that's the case, we could see some improvement in mortgage rates by Friday. The core portion of that index that strips out the food and the more volatile food and energy portions of the index is expected to drop from 4.6 to 4.2 or maybe 4.1%. That's what the Federal Reserve really watches, is that core PCE. That's their main target, has been since about the year 2000. So they like the personal consumption expenditure index better than the CPI, the consumer price index, because it measures a broader swath of the economy. More of the economy is more of the population, and their consumption and spending habits is measured than the CPI. So, however, what they want to see is that core down between 2 and 2.5%. We're going to see it down between 4 and 4.5, right? 4.2, 4.1 potentially on Friday. If it drops lower than that, that would be great news for the bond market and the stock market. But we'll see what happens as that happens. Now, I point this chart out here. I put this chart up here because it's interesting. Today, we see the federal funds rate, I'll use my cursor here, at 5.13. And this week, in 2 days, the Fed meets to raise the rate 25 basis points. Everybody expects that's going to happen. That'll put us at 5.38. If they decide to raise the rates again September 20th, that would put us at 5.63 for that federal funds rate. That's the underlying interest rate that all other interest rates are built off of, right? Including mortgage rates are built up off of that. Now, this is interesting because there's been some economists out there that are saying, okay, when are they going to stop? How do we know when the Federal Reserve is going to stop, and how are they measuring that? What's their thought process? So this shows you that one of the ways that they're watching it, and this appears to be the main way they're considering this, is by going off of the consumer inflation expectation. That's just a survey of people like you and me saying where we think inflation is going to be a year from now. We're not experts, just Joe Blow on the street. And the average on this survey is 3.8%. Everybody thinks about a year from now, inflation will be 3.8%. Okay. So this measurement is if they can get the real federal funds rate, that's what this is FFR, real federal funds rate to about 2.4%, that means it would be slightly higher or basically in line with where they want to be with inflation, right? They want inflation between 2 and 2.5. So if the real federal funds rate is about in line with inflation, that apparently makes sense to them as to where they would stop. So they can do some math here. They'll take the federal funds rate today minus this inflation expectation number of 3.8. That means that right now, the real federal funds rate, according to where they're looking at it, is 1.33. After Wednesday, it'd be 1.58 after they've raised it 25 basis points, 0.25%. And after September, if they raise it again, you'd be at 1.83, still lower than what the Federal Reserve thinks it would need to be to keep inflation in check, right? They want it at 2.4, this real federal funds rate. So what if they looked at it a different way? They use professional economists. They use experts. They have a panel of like 400 economists that they use, that the Federal Reserve gains and gleans information from. Those economists are actually expecting inflation to be at 2.6% a year from now. So if it takes 2.6% off of today's federal funds rate of 5.13, then we're already too hot, right? Then the real federal funds rate's 2.53. That's higher than the 2.4 they want to do. They raise it after Wednesday, we'd be at 2.78. If they raise it again in September, it would be above 3%. So what are they going to use? Which number? I mean, maybe the truth is in between the two. Maybe there's a number in between the 3.8 and the 2.6 that makes sense, in which case they're probably okay with where they've raised them now and maybe even what they do this week, but would not be okay raising rates in September or continuing to raise after that, which would cause interest rates to be too high and really tip the economy into a recession that could be more significant and severe. Obviously, sometimes you need a recession to kind of clear the deck and start over economically, but we don't want it to be major. We want this to be as minimally disruptive as possible to individuals and families and their employment expectations and security. That's an important thing. And so I believe Jerome Powell recognizes that. He seems to have a good head on his shoulders and seems to care about people. But I worry about how they're measuring things, right? If they're just using this consumer inflation expectation instead of their own economists and not trying to find a number in between, hopefully they're thinking this through. Assuming they are, and know where it's appropriate to stop raising the rates before they go too far and tip us into a major recession. So I just wanted you to see that, understand a little bit more about what the real federal funds rate means if you hear that in the news. Okay, let's take a look at the charts real quick. This is mortgage-backed securities today over the past 3 months. Since last Thursday, we've been kind of stuck in this range with a overhead ceiling of resistance, the 25-day moving average. Remember, we want the price to go higher. The higher the price goes, that means the yield and the rate are coming down. So this is an inverse correlation here on the mortgage-backed securities bond chart. So we were at a little higher level here after that CPI report. So you've got a great consumer price index report. And then the next day, there's the producer price index, if you remember that from my videos last week or 2 weeks ago, I guess. And those shot up, right? They caused the inflation came down further more than expected, which caused mortgage-backed securities to shoot up and give us a real nice breather in rates. And we kind of hung around that level until last week, till last Thursday, when it kind of fell apart again because they're starting to get worried. The markets get nervous after a while. They just kind of get stressed out and want to manage expectations. So hopefully we'll see a good PCE report this Friday that drops inflation further down, lower than expected, which could cause the mortgage-backed securities to shoot up to this level. And if it's a really good report, maybe even break through this 50-day moving average and Fibonacci level up into this level up here and get us back to where we were 2 weeks ago with that major improvement in interest rates. That's the hope. Of course, we're not going to know for sure until Friday, but it's going to be an exciting week.